It's a good news story, first and foremost. You've got to break this down into two time periods. What you were seeing in the back end of last year and the very early part of this year, nominal rates were rising at the longer end of the curve, and that was primarily being driven by inflation break-evens. And that's a reflection of the fact that we pulled back from this potentially deeply deflationary scenario that we were in last year to something that said, look, we can now see a path out of this. We're going back to some kind of normality. Central banks might be able to engineer inflation that's somewhere around 2%. So that's a good news story. Now, what you've seen over the past couple of weeks is a different dynamic. Curves have been steepening not so much because of break-evens, but because real rates have been moving higher. And that's what's more concerning for central banks. That's where they start to see this tightens financial conditions. This has an impact on lending rates for corporates and for households. And the idea that central banks would sit idly by and do nothing about that, it's fanciful. I mean, Jeff, no disrespect, but there's more chance of you and Steve winning the Wimbledon men's doubles this year. It's just not going to happen. Central banks are going to intervene in that scenario and say, look, this is a premature and unwarranted tightening of financial conditions. This is not a situation where when you've got 3 years before the labour market recovers, you should be seeing the market tighten in this way. So steepening yield curves, absolutely to be expected. That's what we've been positioned for. I think what most investors have been positioned for is the magnitude and the pace of the adjustments and the underlying fact that it's real rates that have been driving the momentum in recent weeks. That's the concern for central banks, and that's why they're pushing back against it.
Given that I've played Steve on a squash court, I think that you're absolutely right. Neither of us has much hope of making much of a road on any silverware in any of those kind of competitions. But let me ask you a very different question here. What do you think the prospect is to make a lot more money this year just buying plain old index ETFs? Last year was remarkable in the fact that the hedge funds got beaten well and truly into second place by just the headline indices like the S&P. What do you think the chances are of being able to repeat that again this year and our audience just saying, you know what, I'll buy passive ETF at an index level and go to the beach ultimately when the lockdowns are removed?
Yeah, I mean, look, let's be clear. There's no one-size-fits-all answer. It depends on which market you're looking at, depending on market circumstances. So the message from us is not relentlessly be active or be passive. It's very much sensitive to which market we're talking about at what point in time. I tend to think that for this year, you're going to see a wide dispersion of outcomes. You're going to see many companies who benefit from economic reopening where cash flow starts to get generated, and they'll see a revival in economic fortunes. There are going to be many others who, when they start to see the support schemes getting taken out by ministries of finance and treasuries around the world, when perhaps rates and financing conditions do become a little bit tighter, they might find themselves in more difficulties. In other words, the dispersion of outcomes this year, we suspect, could be far wider than it has been in historical years. Now, when the winners and the losers are on top of each other, there's not necessarily a strong case for saying pay the active fees. But when you've got this wide dispersion of outcomes, the winners and the losers are poles apart, then I think there's a very strong case for saying you need to be thoughtful about security selection. So it very much, I think, favours active investment for this year. Not relentlessly. There are some exceptions to that. Some markets where passive will work perfectly fine for this year. But generally, I think this environment favours active investment.
James, love your analogy about the tennis, by the way. We're all chortling about that one. By the way, Jeff is a far superior squash player than I could ever be. But in terms of this wide dispersion of outcomes, I actually think that you're spot on. But my worry is, because of your previous answers about the weight of money that's still going to be around for a very long time, will the market be able to spot the wide dispersion in terms of performance because they're just buying everything in a correlated fashion?
Yes, I think directionally we're talking about equity markets moving higher. We're talking about credit spreads remaining very tight. And yes, yield curves steepening somewhat, depending on which market we're talking about. But generally, the message is equities higher, spreads tighter, curves steeper. But that doesn't mean that everything moves uniformly. So take equities, for example. If the message is higher, it doesn't mean that everything moves higher by the same amount. You can have a wide dispersion within that. So fine, if you've got all this liquidity sloshing around the system, if you've got super low rates for a long period of time, you've got an improved earnings outlook because economies are reopening, that's beneficial for most companies, but it's going to be unevenly beneficial. There'll be some who massively outperform the market. And that's what we're saying, that whatever view you have on whichever market, you should be expecting a wide dispersion within that. So I guess what you're saying, to paraphrase you, Steve, you're saying a rising tide lifts all ships. And I think there's an element of truth in that, but it doesn't mean that in this particular situation, everything rises uniformly.